What if I told you that trying to pick the perfect moment to invest is actually the single most expensive mistake you can make with your money? We've all been there. You look at the stock market, it's red, it's dropping, or maybe it's at an all-time high and you're afraid to buy the top. So you wait, you tell yourself, I'll start when things stabilize. Or, I'll start when I have more money. But here's the hard truth. While you are waiting for the perfect time, you are losing the most powerful weapon in investing. And that weapon isn't luck. It isn't insider knowledge. It's time. Welcome back to Fiscal Beacon, where we cut through the noise and give you clear, actionable advice on managing your money. Today, we're talking about the snowball effect of investing. We're going to explore why time in the market beats timing the market every single time. By the end of this video, you'll understand exactly how compound interest works, see real numbers that might surprise you, and have a clear plan to get started. So, let's roll up our sleeves and get into it. First, let's define what we mean by the snowball effect. You've probably heard the term before, but let's look at it through a financial lens. Imagine you are at the top of a snowy hill. You start with a small snowball. As you roll it down, it picks up more snow. But here's the key. It doesn't just pick up a little bit more each time. Because the snowball is getting bigger, it has more surface area to collect even more snow. The growth becomes exponential, not linear. In investing, your initial money is that small snowball. The returns your money earns are the snow it picks up. But then, those returns start earning their own returns. This is called compound interest. Albert Einstein reportedly called compound interest the eighth wonder of the world, and he wasn't wrong. It's the process where your money earns interest, and then that interest earns interest too. It's like having a money-making machine that never sleeps. Now, let's make this concrete with some real numbers. This is where things get interesting. Let's look at two hypothetical investors. Let's call them Alex and Sam. Both have the same goal, to build a retirement fund. They both aim for an average annual return of 7% after inflation, which is a reasonable historical average for the stock market. Alex starts investing at age 25. Sam waits until age 35. Both invest $500 a month. That's it, just $500. Maybe it's a modest contribution from a side hustle or a portion of a paycheck. Now, let's fast forward to age 65. Alex has been investing for 40 years. Sam has been investing for 30 years. Who do you think has more money? Most people guess that because Alex invested for 10 extra years, they might have a bit more. But let's look at the math. Alex, starting at 25, will have contributed a total of $240,000, $500 x 12 months x 40 years. At age 65, that pot of money will have grown to approximately $1.15 million. Sam, starting at 35, will have contributed a total of $180,000, $500 x 12 months x 30 years. At age 65, Sam's portfolio will be worth about $570,000. Did you catch that? Alex has more than double the money of Sam, even though Alex only contributed $60,000 more. That extra $60,000 grew into nearly $600,000 of extra value. That is the power of time. The first 10 years Alex spent investing didn't just add $60,000. They added over $500,000 in value. Why? Because those early dollars had a full 40 years to compound. Sam's dollars only had 30 years. The gap widens the longer you wait. This is why waiting for the perfect time is so dangerous. When you wait, you aren't just losing the money you would have invested. You are losing the time that money would have had to work. And time is the one asset you cannot buy back. Once you turn 35, you are permanently 35. You cannot go back and invest at 25. But let's address the elephant in the room. You might be thinking, okay, Fiscal Beacon, but what if the market crashes? What if I invest and the value drops 50%? Shouldn't I wait until it comes back up? This is the classic timing the market trap. It feels logical. We want to buy low and sell high. But here's the problem. No one knows when the bottom is. Not Warren Buffett, not the experts on CNBC, and definitely not you or me. Trying to time the market is like trying to catch a falling knife. You might think you're getting in at the perfect moment, but you're usually just getting cut. Let's look at a historical example. In 2008, During the financial crisis, the S&P 500 dropped nearly 50%. If you had waited for the market to stabilize before investing, you would have missed the entire recovery. The market didn't just bounce back, it surged. If you had stayed on the sidelines for 2 years, you would have missed some of the strongest gains in history. Those 2 years of waiting would have cost you tens of thousands of dollars in potential growth. Think of it this way: the stock market is like a staircase that goes up, but takes detours. Most of the big gains happen on the days when the market is volatile or even dropping slightly. If you miss just the 10 best days in the market over a 20-year period, your returns drop by more than half. You cannot predict which days those will be. So, the only way to ensure you catch those big days is to stay invested through the ups and downs. You have to be in the game to win the prize. Now I know what you might be thinking. I'm 40 years old. Is it too late for me? The answer is absolutely not. It is never too late to start, but we need to adjust our expectations. If you start at 40, you don't have the same luxury of time that Alex did. So, you need to be more aggressive with your contributions. Let's look at another scenario. Let's say you're 40 and you start investing $1,000 a month instead of $500. Let's say you continue until you're 65. That's 25 years of investing. You'll contribute a total of $300,000. At a 7% return, that will grow to roughly $900,000. Compare that to starting at 25 with $500 a month, which we saw grew to $1.15 million. The gap is smaller, but you still have nearly $1 million. And if you increase your contributions as your salary grows, that number goes up even higher. The key takeaway is this: start now. Start with what you have. Start with $50. Start with $100. The habit of investing is more important than the amount. Once you start, you're in the game. You're rolling the snowball. So how do you actually start? It's simpler than you think. First, open a brokerage account or a retirement account like an IRA or a 401(k). Second, choose low-cost index funds or ETFs. These are baskets of stocks that track the entire market, like the S&P 500. You don't need to pick individual winners. You just need to own the whole market. Third, set up automatic contributions. Treat your investment like a bill. Every month, money leaves your account and goes into the market. This removes the emotion. You don't have to decide whether to invest or not. You just do it. This is called dollar cost averaging. It means you buy more shares when prices are low and fewer when prices are high, smoothing out your entry price over time. Remember, investing is not a sprint. It's a marathon. There will be days when your portfolio looks red. There will be years when it feels like nothing is happening. But if you keep rolling that snowball, the growth will happen in the background. It's boring, it's slow, and it's incredibly powerful. We've covered a lot today. We talked about the snowball effect of compound interest. We looked at the stark difference between starting at 25 versus 35, and we debunked the myth that timing the market is a viable strategy. The lesson is clear. Time in the market beats timing the market. If you found this video helpful, please hit that subscribe button and turn on notifications. We're building a community of smart investors here at Fiscal Beacon, and we want you to be part of it. Next week, we're going to dive into the 50-30-20 rule, a simple budget for busy people. We'll show you exactly how to allocate your paycheck without feeling deprived. Before you go, let's do one thing. Go ahead and open your banking app or brokerage account right now. Just look at it. If you don't have an investment account, take 5 minutes to research one. If you do, check your contribution settings. Are they automatic? Can you increase them by just $10 a month? Small steps lead to big results. And remember, I am an educator, not a financial advisor. This content is for informational purposes only. Always consider consulting a financial advisor before making significant financial decisions. Your situation is unique, and professional advice tailored to your specific needs is always the best path. Thanks for watching, and I'll see you in the next video. Keep rolling that snowball.